Hello, ladies and gentlemen. Welcome to today's tutorial. Today, we're going to do RISM Graduate Entry Scheme, August 2026 Exam Brief Guide. So we're going to do is Applied Valuation 1, also for Applied Valuation 2. With me, Thong PV3377, PA4525. So today, we're going to work on this particular one called Residual Method under Income Approach. Again, you need to know your Malaysian Valuation Standard 2025 compliance, that is MVS 7, regarding Income Approach, AV1 and AV2. Residual Method, more specifically for development land and for property developers. So let's go into it. Fundamentally, for residue method, MVS 7, AV1 and AV2, these questions will come out as an exam question to you in AV1 and AV2. The definition, a subset of income approach used to determine the value of development land. So most scenario, when the question comes out, it's actually for property development where they will ask you how many units property for sale times the prices, the construction costs, and also then you get the developer's profit. Now, the core principle is very simple. The value of the land is the residue, what's left after deducting the cost of development. The developer profit from the gross development value, basically like revenue minus the cost minus the profit the company wants, and then what you get is a residue value. That residue value is basically called the land value or residue value. Now, applicably is for land with development potential. So you tend to see questions that has what we call the land and everything else here. Market alignment, for market value, all inputs GDV cost profit method also must be discounted. We call it PV or present value. You must take into present value to derive it to be market value. Yeah. So what's the formula? The formula is really easy. You just need to remember the equation is development land equals to GDV minus TDC plus DP. So you have to memorize this particular formula so that when you do the past year question at the time, you have to follow GDV minus TDC minus developer profit. Then, of course, you get your development land, the residual value. Then you take in consideration of the discount rate, we call it PV or present value. Then what you get is the market value. So gross development value, GDV, that's what it means. Okay, then total development cost and developer profit. In case the question does not provide you with any developer profit, the percentage, you can take between 25 to 30 as an assumption. Yeah. Let's move on to the third one. Technical exam focus for RISM, especially present value. Candidate must be proficient in discounting the GDV, the cost back to at the valuation date. So the present value has a time period, we call it N, and that one will be based on the development period. Most of the time, RISM exam, they will provide you with a construction period of 2 years if it's landed property, 3 years if it's strata or multiple level. Okay. What you do is to get the development value, you plus 1 more year. So if it's construction 3 years, then you plus 1, it becomes 4. So then you take 4. The development period understanding the impact of the timeline on the final value. So how long it takes? 1 year you have to get for approval, and then 3 years construction. That's why you need to have 1 more year. Then the theory requirement, ability to discuss the specific advantages and disadvantages of residue method. Sometimes, recently, they come out question in theory. They will ask you what is the benefits and the disadvantages of residue method. You must know it because then you have to study the theory. And then problem solving, focus on technique of answering exam questions specific on land value determination. You tend to see this in AV1 and AV2 as well. Quite common now. It came out for 2025, 2024, 2023 as well. And then this is, again, there is a process. The process is basically you need to start with GDV. You have to calculate the number of units of property that can be sold at the market value, whatever SPA price. You get what we call like a revenue, if it's in accounting, but it's called gross development value. And then you minus with your development cost, of course. And then you minus the developer profit, and then what you get is a residual value. But residual value, according to MVS 7, you need to discount it using a present value formula. Then you get what we call the market value. Now, there are some assumptions that you must take here. Assumptions would be, first, you get a question. If they don't tell you there's a Bumiputra quota, you must assume there's a Bumiputra quota. In Malaysia, every property sold has a Bumi quota, like 30%. Then you have a Bumiputra discount. Now, some certain states are higher, some states are lower. What you can do is either you take 5 to 7%, and then you have a developer profit. You can take between 25 to 30. Development period, remember, for 2 years, development period could be 2 years for Schedule H, if they put it H, 2 years, and development period for for G is 2 years, for H is 3 years, and then the present value you can take between 7% to 8%. So this is what it is. And if you look at the question and you look at the development cost, you get words like professional fees, promotion and marketing, contingency fee, that you have the building cost. So when you identify the question according to this, then you know it is a residual method. So then you just remember back your formula: GTV minus TDC plus development profit bracket equals to land value. And then when you discount it, you discount whatever left, the remaining value called residue method. You discount it with a PV formula, you get what we call market value. With that, thank you for watching. And we will come back with another series. On this time, we will do profit method. Take care. Bye bye.